Financial lessons I should have learned in school. Taxes. Welcome to our second mini lesson in our Financial Lessons tax course. In this mini lesson, we will go through some basic tax rate calculations based on our tax filing statuses. So let's calculate a few of these examples. In our first example, this individual is single. They have a filing status of single. And so we can see on the left side of our screen the tax rates as well as the tax brackets. And these correspond to an individual who is filing as single. In the first tax bracket, the individual's income that falls between 0 to 10,275 would be taxed at a 10% tax rate. The portion of their income that falls between $10,276 and $41,775 would be taxed at 12%. The portion of their income that falls between $41,776 and $89,075 would be taxed at 22%, and so on. One of the common misconceptions that I hear from my tax clients is that they think that whichever tax bracket their salary or their taxable income falls in dictates the percentage their entire income is taxed at, and that is not true. For example, if someone makes $250,000, their entire $250,000 is not going to be taxed at 35%. Only the portion that falls in that 35% tax bracket would be taxed at that percentage rate. Another misconception that I hear a lot is that people think that they can pay 10% of their taxable income, regardless of what it is, and meet their tax liability. And that is just not true. As we can see, if you make $100,000 a year, portions of that $100,000 are going to be taxed at a rate that is greater than 10%. So if you only pay 10%, you most likely are not going to have paid enough to meet that tax liability. So in our example, our individual has $70,000 of taxable income. Now it is important that we are noting that it's taxable income, not total income. We will talk a bit more and learn more about what those different definitions mean in a subsequent lesson. But for now, just make sure you remember that only your taxable income is calculated to determine your tax liability. So, since they made $70,000, we know that we're going to stop at our 22% tax rate because that's where the $70,000 is going to fall. We know that the total portion of their taxable income that falls in the 10% tax bracket is going to be taxed at 10%. We know that the total portion that falls in the 12% will be taxed at that rate. And then the portion that falls between the $70,000 that they made and the $41,776, which is the bottom of the 22% tax rate tax bracket, will be taxed at 22%. And so if we do those calculations, then the first portion in the 10% tax bracket is going to equal $1,028 of tax liability. The second portion, which is the $41,775 minus $10,276, that gets multiplied times 12%, will give us $3,780 in tax liability. And then the final portion of their salary, which is the $70,000 minus $41,776, which is at the 22% tax rate, will give us $6,209. And when we add those three together, it gives us a total tax liability for this individual of $11,017. So Let's look at another example. In this example, we have a filing status of married filing jointly. And so this is a married couple, and their taxable income is $150,000. So again, we know that the $150,000 is going to fall in that third tax bracket at 22%. So all of their income that falls in the 10% tax bracket up to the $20,550 will be taxed at 10% to give us $2,055 of tax liability. All of the income that falls in the 12% tax rate tax bracket will give us $7,560. And then the portion that falls in that 22%, which is going to be that 150,000 minus 83,551, is going to be taxed at 22% to give us 14,619. And when we add those three together, that gives us a total tax liability for this married couple of $24,234. And so this is a simple way of looking at how to calculate your tax liability. Something that's going to be important throughout this course and throughout your tax journey is to remember that tax law gets updated and changes from year to year. The different tax rate schedules and the different portions of the law are going to change as law is passed through, the Congress or Senate, and also as cost of living gets put into place. So it's going to be important that as you go through your tax situation, you make sure you're using the most up-to-date information. Those tax rate schedules that we looked at in this particular mini lesson, along with some of the others that we'll look at, are what are currently available. But they change from year to year. So if you continue to use the same thing, at some point, you're not going to be accurate in your calculations. So it's going to be very important that you update your tax rate schedules each year as they change. And also be sure to use taxable income in estimating your tax liability. We will talk more about what that definition means and other things as we continue on our journey. So I will see you in the next lecture.